Recently on my podcast, I had a lender come on who has a product that solves two really big problems when it comes to buying rental properties. The first problem people have when they start buying a lot of rentals is they get capped out. This is either due to Fannie and Freddie's terms or it's due to their income. So many people, after they get about 10 properties, can't buy anymore. The second big problem with loans on rental properties is the cash flow. So many properties do not cash flow in today's market. As you can tell, prices are really high, interest rates are high. So buying properties is pretty hard to cash flow in today's market, but it doesn't mean that they're bad deals. In fact, many of my best deals that I've purchased are properties that didn't cash flow at the time, but now cash flow a lot just a couple of years later. So in this clip, we're gonna go over products like DSCR loans, which solve a lot of those issues, as well as my philosophy on buying rentals. So hope you enjoy.
There's a lot of people freaking out about the market, like, oh, real estate's gonna crash, the rates are so, high now. Like, what are you guys feeling like?
Well, I mean, honestly speaking, right, we are in a situation, it's kind of strange because we are at an equity high situation, which means that a lot of people, a lot of homeowners have a lot more equity than they've ever had in the past because home values have risen so much. So even with kind of the higher rates, even with everything going on, we're kind of noticing a lot of people are utilizing, cash out options to maximize their equity and also just being able to kind of see how much they've, amassed in terms of on paper with their valuations of their home. And they're just not really moving with it. So in terms of a crash wise, I don't really see it coming anytime soon in the real estate market just because everyone has so much equity. Right. Everyone needs to sell in order for a crash to happen, and people aren't selling. There's no supply, but a lot of demand.
Yeah, and, because rates are higher now, it's like, dude, if you sell, you might lose that low rate forever.
Yeah,
exactly.
Right. So I'm just like, I don't see how at least real estate has like this big recession. Like now everything else, okay, like stocks could go up, stocks could go down, crypto could go down, but I have a tough time seeing how real estate goes down. So, but anyways, what I think's interesting is as a lender, there's like multiple ways that you guys make money. It's through either financing the purchase of a home or refinancing, essentially, right? Mm-hmm. Yeah. So you guys made a killing the last couple of years on refis, right?
Yep.
Correct.
Like how many people were taking advantage of refis, would you say?
I mean, our book of business, last 5, 6, 7 years was 90% refis.
Yeah.
And today we're probably doing 80, 70% purchases. And we knew this was kind of coming. We didn't know when, but when we started Convoy, we knew this was coming in terms of rates increasing, right? So we decided that we were going to tap into the investment side of things, like really trying to tailor to real estate investors, because real estate investors are a little bit less rate sensitive than somebody buying their first home.
And their repeat business.
Yeah,
exactly.
Absolutely.
So what kind of products are you doing for investors right now to kind of differentiate yourselves?
So our most popular right now with a lot of our investors is, obviously a lot of people have kind of heard of it. It's the DSCR loan, debt service coverage ratio loan. It bases the entire loan on the cash flow of the property instead of using, normal traditional income, just making sure that the actual rents can cover the mortgage payments. And we have lenders that we used to have more, but with the recent market shift, because it shifted, again, we have lenders that'll still do coverage at as long as there's potential coverage at 50% or even 0% coverage right now. We have a few lenders that'll do that just because they see the potential in the future of that property as a real estate investment rather than the value of it right now.
So go over what 0% would mean.
So that would mean that the monthly rents right now don't cover the mortgage payment at all.
Really?
It doesn't cover at all.
Okay.
So it's non-existent at this point in time.
Right.
Yeah. But they would see the property and kind of assess. Obviously, it's a little more down, right? It's a little more, if you're going to purchase something on 0%, coverage, and I should clarify coverage, not, down, but 0% coverage, then that means that, hey, the deal has to really look good long-term, and the lenders have to see that, in the property itself, in the deal itself. So right now may not cover, right now may not work, but who knows, in their calculations, 5 years, 3, 5 years, 10 years down the line, it may just be a cash king. So cash flow king, I should say.
Yeah. And I actually resonate with that now because growing up when I was learning real estate, you know, you always hear like, don't buy it if it doesn't cash flow. Like that's every investor's big deal, right? And, you know, used to be like, oh yeah, there was this thing called the 2% rule, which is like basically non-existent now.
Yeah.
Where it was just like, yeah, you know, your rent should be 2% of the price. Like, so if the house cost whatever, $100,000, this should rent for $2,000. It's like, that doesn't exist, you know, but apparently it did back in the day from what I'm told. And, you know, now you look at it and you're like, dude, like if I could get like 0.6%, you know, it's pretty good.
Yeah, exactly.
Especially in a good market like Vegas or Cali or Phoenix or something like that. And even then, you know, still, I just was like, I don't want to buy these as rentals. They don't pencil out as far as cash flow goes. And so, you know, I've talked about this on my YouTube channel, like maybe a couple years ago. Like a house in Vegas was $300,000, like a newer house, track home, good area, and they would rent for like $1,800. And back then rates were still like they are today. They're like 5%. And you do the math and you're saying like, yeah, it rents for $1,800 and the mortgage would be $1,800. And then you still have other expenses on top. Like this would lose money every month. So I never kept them or bought them. And I was just like, why would someone do that? Well, the reason someone would do it was, to your point, you know, just 3 years later, that same house is now worth $500,000.
Yep.
That same house rents for $300 to $3,500. And if your mortgage was $1,800,
Yeah.
dude, you're killing it.
Yeah, exactly.
If you just would have bought it.
Yeah. Yeah.
And so I've kind of shifted my perspective now where I'm like, yeah, you know what? If I believe that in 5 years, 10 years from now, the market's going to keep going way up, if I lose a couple $100 a month the next couple of years, I don't really care.
Just write it off.
Yeah.
Right?
Yeah.
Yeah.
Well, and the tax benefits too.
Yeah.
So, like, one of the things why I've kind of taken this approach now is, okay, let's just say I buy that $400,000 home and I do a cost segregation on it. I can get like a $100,000 write-off. Okay, so if I get a $100,000 write-off, that's $40,000 in taxes. So if I was negative $200 a month in cash flow, but I save $40,000 in taxes, I'm like making a lot.
Yeah.
Yeah.
So I don't know. For anyone listening, look, this has just been my strategy lately, and that's who these guys are trying to, you know, target with a 0% deal, is for somebody who can play the long game, somebody who can afford to say, yeah, you know what? I don't need cash flow. It's okay. Because we see the 5-10 year picture with this deal.
Yeah. And to that point, just to also add to it, if the property is vacant, like units that are vacant, our lenders actually, you know, a lot of lenders we work with will actually prefer that more than units that have tenants in there, because they can use the actual market rents of the area or air DNA data or short-term rental data instead of having to use a standing lease, which is usually right now in this market for the last 2 years, rents have been low, right? So we don't want to use that lower data. They want to use the future data, the pro forma data, for what's actually, you know, realistically supposed to be cash flowing at.
Yeah. So this is actually called loss to lease for those listening. And we're doing a deal in Phoenix right now where it's that exact scenario. And that's why we're getting great value. So we're buying this 44 unit apartment complex for $13.2 million. And we literally got the appraisal back today, and they said, hey, this thing is worth, as of today, right? And, you know, they're like, assuming you put your $400,000 worth of CapEx that you're planning to do, this property's worth $15.8. And we think that in 2 years, it's going to be worth 17, 18 mil. And which was good to hear because it was right in line with how we saw the deal too. And this is a third-party appraiser and everything else. And, you know, basically the value is weird because you think in fix and flip and development stuff, it's like you're taking something that's beat up, you know, whatever, and you got to fix it up. That's how you get the new rent. But this property we're buying is in perfect condition. It doesn't need really anything. It was renovated like 2 years ago. So why are we getting a deal? Well, the leases. All the leases are old. And so they're renting for like $1,300 a month when in reality the market rate is $1,700. And so in the next 2 years, all we have to do is just renew leases
Yeah.
Yep.
at market rent. and that turns the value into 17, 18 million.
Yeah.
Exactly.
And in 2 years, it'll be higher too.
Yeah, that's us betting like today's numbers
Yeah, correct.
right now.
Correct.
Exactly.
So what is the details of that DSCR loan? Like what are the rates, how much down, how many years, all that stuff?
Yeah, so they are in terms of you can get your traditional 30-year fix, just like a conventional loan, but where most of our clients are trying to get is the 30-year like interest only or a 40-year interest only. What it is, it's 10 years of interest only, kind of allows the investor to capitalize on cash flow those first 10 years. And then it just converts either to a 20-year fix or a 30-year fix, fully amortized during that second portion of the loan. But what's nice is the rates fixed the entire time. You know, rates are still in the 5s on that product.
They're still in the 5s?
Still in the
That's
5s
the
on
same
that
as a
product.
normal conventional.
Exactly. And you know, the if you're trying to purchase something, we normally to get the best rates, you want to put 20% down. A lot of conventional lenders will require 25. If it's a really good deal and the property can cash flow at a certain number, let's say 1.1 or 1.2, so you know, for your audience, if the market rents, let's say $1,250, and the mortgage payment we're calculating is $1,000, right? That'd be at a 1.25 ratio.
Right.
We might be able to get you 10% down. You know,
Right.
Cash out, go up to 75 or 80. All pretty, a little bit less stringent than obviously your conventional kind of financing options out there.
Yeah, I'm surprised at how cheap the rate is for that kind of product because, you know, I've gotten, you know, what do they call them? Non-QM products.
Yeah.
So what is QM?
Qualified mortgage.
Yeah.
Yeah.
So, you know, basically non-QM is these creative type loans, right? And so I've done a bunch of them and I've had some where they're like 7, 8%, right? I'm like, man, that sucks, but whatever, right? We don't really have a choice. You know, I want to buy this deal. It's a good deal. And yeah, I'm paying an extra $100, $200 a month in interest, but it's all good. Thanks for watching that clip from the Ryan Pineda Show. If you want to see the full interview, you can actually find it in the link below. Make sure you also subscribed on both YouTube and Apple Podcast.